345 orders were from one single market participant or were from multiple market participants. For example, then, if I'm in one position and I start to see that on this level you have all this aggression of the buyers, but the price cannot advance. Instead of waiting, maybe I will start to trade my stock below the last aggression. Because if this one fails, the market will reverse. If on this opposite side, on the bottom side, I start to see the buyers, okay, pushing the auction with 300 contracts, confirming the auction. This is what I use when I want to trade my position. Okay, so when I have in the body, probably I cover below here. Why? Because I know that this player will come to below the position exactly there. Look at this event at the bottom side. Let's go to the other setup that I showed you also here. How much was easy? I don't know if you can see that here. There are 111 contract absorbed. So the order flow is giving you just a dataset. You need to validate it with your bias and your idea, but this kind of data have countless applications that you can make on the algorithmic and on the discretionary side. But if you can, I don't know, I don't have a bias. Can I just buy a data set and be profitable? No, because it will just be the same as saying, look, I am a data analyst. I buy a data set and I become a data analyst. You need to be a data analyst, no? And also here you can see how much aggression the market supported here. So you can see that the market was following up on the aggression. And when they came back, the buyers tried to put the auction higher, but got absorbed again. So this is what I usually use. And also when I see huge contract like 167, it's a lot. And the buyers pushing on the other side, usually the market bottom down in this way, okay? Because it's a confirmation on the opposite side. Another thing that is really objective data that I would like you to take a look to is the profile, no? You can measure this in price action, you can measure from the bottom swing to the top swing and remove the price, okay? Why this one is useful? Because we can go directly in the analysis of who is dominating this frontier. And we can see, look here, Brandon, that we have the land of nowhere, because this is balanced. And then we have what is called discount. Imagine you are in the Apple store, this one is the price of the new iPhone. If you go below, you are discount. We want always to mark this area. So we will take the area into account. Okay, this area here. Let's make with the marker so it's even easier. One and this one here. We can see that here, buyer's aggression, really relevant. A lot of sellers absorb and we have the value area low. Okay. When we go back.
As a father, my kid's safety always comes first. After I learned Michael Watley hired a child sex predator, that was different. Protecting political friends instead of our kids, Michael Watley should never be Senate.
During the Beauty Rest Labor Day sale at Mattress Warehouse, save up to $1,000 with the purchase of select Beauty Rest Black adjustable base sets. Plus, get 0% financing for 60 months and free next day delivery. Now at Mattress Warehouse.
For your cleanest, freshest morning ever.
That's fresh.
Yeah, it is. Try Fresh Pro Health mouthwash.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 stocks and ETFs, plus futures markets, all with 24 hours support. There's a quiet magic at work here, one conjured through time and tradition. It can pull us out of our rooms, away from our screens.
Price. If you do proper testing, you can notice that price feel this level. And this is not for me, for you. This is just executed order. Everyone can see it, okay? So the buyer's aggression that executed from here was way more relevant than everything that happened here. So if you want to consider a buy, you want to have your confirmation, but try to use your confirmation to buy from levels that are relevant to the order. Okay? So this one is just an additional layer that is sending to a trader to refine the entry that it's making.
And then the entire model, as you said, on the exit side, just to clarify, this would be more of a longer position holding.
This is scalp to intraday, so it's taking shorter position to get the intraday drift, and then you can have also aggressive scalping. Aggressive scalping, Brandon, is not to take the main drift, is taking position. Let me show you, for example, I use the order track. This one is watching the different thing of the market, okay? This one is watching in each single candle who is dominating, the migration of the value area, okay? Let me give you an example. The sellers are dominating on this one. You can see this big delta, and you can see that the profile is pretty balanced, okay? Let's go on the next candle. We see a lot of sell aggression, but candle closing by, and value area still lower. When we have the confirmation that we are switching value from the closing of this value area, why? We were in a downward drift, value area was shifting lower, value area now is switching higher. Here sellers were dominating, look here, who is dominating buyers. This one is what I use to load my one-to-one. So you will say, one-to-one is not, this one is in the correct direction of the order flow with a really consistent method that is to reward. Okay, so if you are good at understanding the main direction of the day, you can scalp every single movement in that direction. Instead of taking 1 to 5 risk reward, taking maybe 3, 4 position, 1 to. Why it's smart this? Because even consolidating market will give you profit. When you go 1 to 5, you can stay in one position for longer. Let me give another example. This was the first one. Now we continue higher. You can see that the value area migrate higher. The candle still green. If this idea is validated, what I expect that the value area will protect and reload higher, so I can put my position at the value area, hovering below, going for another one-to-one. The same when I close this candle, and here it's where I don't know if I would have taken a stop loss, but let's no one-to-one. Also, this one that was against you, maybe it could take your stop loss before, okay? But anyway, you have opportunity where the market is compressing and it's splitting. No. Okay, let me give you a complex example. Value is still switching higher, but here the value is switching lower. The sellers are dominating. So an example for the sell side will be stop loss above the value area I protect, still machine gun to one-on-one. The market continue lower. Okay, what I can see that this candle goes here, I take a target, and I need to wait for the market to realign. This sell candle is still close inside here. If we break below, I will leave the same position. The market tell me no, we are not going down. The market flip from value area to value area high. My position here, stop loss below the value area, no, I will take another. Okay, look here, we switch where with this, but it's a green candle. We stay red, and then we switch lower. We have another position, the same logic, value area here. And then you say, can you use discretional analysis on this? Of course. Okay, so when you go inside the candle, you can read who is dominating. Let me give you a perspective on this. This is the maximum, the point of control of the candle, no? Is much lower from the previous one? Yes. What does it mean? That the value is migrating lower. Okay, perfect. What do we have here? We have the next candle trying to engage and break this level. A lot of buyers activity, zero result. What does it mean? That there are a lot of positive orders continuing. Also, if the candle is developing, when I see all this absorption, I can also try to go a little bit aggressive and squeeze a 1 to 2. Okay. But the objective of the model is not to build huge risk reward, it's to build consistent equity and then maybe risk the equity of the profit that you make for bigger position.
You know, obviously with reward risk ratio and win rates have a symbiotic relationship in a sense. Obviously, higher reward risk win rate goes down. So we know win rate isn't the most important thing. But with this 1-to-1, sometimes 1-to-2, do you have a win rate that comes with this model?
It's not always the same.
Ever thought about getting into prop trading? Perfect timing. Right now, we have a huge offer for you. You can grab a 50K futures challenge for just $9. Or if that's still too much, the 10K crypto challenge for only a single $1. Links in the description. And now back to the video.
you can have also 3-4 take profit in a row when you take a drift. Because let's take, for example, this one, in which lower, first one position is second one until second position TP, then you switch. Another position long because you switch on this one, take profit. Okay, this one stop loss, and then you start to go down. Take profit, take profit. Okay, so you can have a positive drift. It's not distributed, okay, but you can have a positive drift. The win rate of this model is very high. But if you tell me, will you automate it? No, and I explain you why. Because the automation don't take into consideration all the analysis and refinement of the position management. Let me give you an example. Let's say that went at here. Okay, this candle was here. The model will leave the risk here. But here I see that there is a good fire shop. So I trail my stop loss and I reduce the risk to zero. When I see that the drift is sustained, like the one that we had in the closing range, I build a position. Let me give an example of position building. We flip higher. Okay, what does it mean? That I can position myself here at the absorption or here with a stop loss below here. The market confirmed. I take my first position to risk free because I can cover the aggression and I can load another position and the extreme delta. And the market, then the market was closed. But in days where that drift brand, you can build 3 or 4 rolling positions with the net risk of one. So it's not linear, the world, it's exponential, but there are also negative days with this model. For example, when it's extremely choppy, you can have a rate around 40-50% that is break-even because it's 101 plus costs. So it's not the ordinary, unfortunately.
Well, does this only work in specific markets, or would you think this?
I took the time only to test Nasdaq, but I think this is the nature of the market, how the value migrate, the actual data set of the orders. I think it can work in other markets, but I don't want to say it because I didn't do proper testing, so I don't want to spread misinformation on this one.
Right, and so then basically your answer to that also opens up that just because a strategy works one market, even in a highly correlated market like ES, doesn't mean it can just jump right over to that.
I have models that are profitable in Nasdaq and lose money in ES and opposites. They are correlated. The fact that it's correlated doesn't mean that the microstructure is the same. This is microstructure pattern, okay? And it can be different for a lot of assets. So also people taking profitable strategy on gold, pretending that they can apply on Nasdaq and be profitable, just madness, because you are doing a big assumption. It's like you are saying, you have been successful in trading, so I also will be because you have been. It's not like this.
And when did you develop this model?
This model here, it's 6 months, about building 6 months. Before it was not using the value area, was using only the aggression and the big trades. But then I find out that the value area is adding a lot of value. It's a game of words, but it's adding a lot of value because it's giving you how much sustain is the drift. The more the value area continue to drift up, you see building, the more you can build your position. And sometimes it's not like this with big order because they can be distributed in all the candles. So the next candle can retrace. You see a big order here and you close. But the value area is making sure that you keep all the drift as much as it lasts. You can see also here. These are directional. Then also this choppy moves where you give back some profit of the market. I only trade trend following model at the moment. So it's normal that when the regime is not correct and the market is just not moving, you will give some profit back. It's part of the game.
Now, would you say that with a model like this, is the value area then the most important piece of this? Would you say?
I will say that value area associated with delta profile is incredibly important for this model. And the last tweak that I add to it is the Nasdaq effort area. That is the one that I'm using also in the other model. When I have a value migration that is going higher, and also the area telling me, look, the pressure is still on the upside, I have all the information that I want pointing up at the same direction. Let me show you, for example, if you only filter for setup that have all the confirmation, you will take this value here, 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 and this value here. So you'll take 6 trades, 5 take profit and stop it. Okay. Here, when we are migrating lower, I will only take this one because it also this one. So it's a confluence of information without overthinking. Because the risk is that if you continue, like what they say, Brent, they say, if you stress the data long enough, it will tell you what you want. And you know, because you were an algorithmic trader, so you know that if you stress, but if you go on, you go back and you start to see how the price, these are real time, how the price reacts to this area, you can understand that the order flow is actually influenced in the next and can have really bad shocking. This was an amazing buy opportunity. And this is an example when you are chopping like an amazing sniper shot, free stop loss that you taking of this is part of the market. It's part of how the market is developing.
So would you say that's the biggest, every strategy has a weak point, right? So would you say that's the biggest Achilles heel in the system?
All depend on the system suffer from confusing and they accept. I accept. Playing it out where I have a consolidation. My goal there is to protect capital.
You just got hired as a Domino's beta tester. Just order some pizza and you'll get paid $5 towards next week's order. I can't lie. Only use AEW Championship. Hello everyone, welcome to another Trifecta educational video. So let's look at a chart like this. I can probably find liquidity above price. I can probably find liquidity below price. If I mark every swing high and every swing low, eventually one of those levels is going to get taken. But does that mean I predicted anything? If price is going higher and I say, I see it took buy side liquidity. And then tomorrow price goes lower and I say, see, it took sell side liquidity. I'm just explaining the chart after it already happened. That's hindsight. That doesn't mean anything. It doesn't mean I did it on my own. It doesn't mean I predicted it. That just means I drew some lines on the chart and eventually they got taken. What I'm trying to do with the trifecta is totally different. Before the move even happens, I want to answer, where should price be delivering next? Then, which liquidity makes the most sense as the objective target for that delivery? That distinction is what makes it extremely important to do so prior to the move. So that's what this video is going to be about. How to know which high or low MQ will target next. This is my gold bar draw liquidity framework. Every draw liquidity is obviously liquidity, right? But not every liquidity or not every swing high or low is the actual draw. That is what I mean by this statement. So the first mistake traders make is trying to find the draw in liquidity before they have established direction. I don't want to look at a high and say there's liquidity there, so price should go higher. That's backwards. My process starts with the environment, then directional bias. And after I understand the direction I'm expecting price to deliver to, that's when I start to narrow down the draw in liquidity. So most traders mark previous highs, previous lows, session highs and lows, and random swing points, right? But again, the real question is which liquidity is the one that's going to get taken if both sides look valid, right? If both sides look valid, you don't have a model yet. You still need your directional bias, right? That is what the slide is for. All right, so let's think about the process. Let's think of our orders of operations, right? Sounds pretty cool, doesn't it? So we don't use random liquidity to create our bias. Our bias chooses the correct liquidity based on these steps that you see here, right? I'm not going to go deep into each one of these steps, but these are the frameworks that I personally use. First, we have our environment, then we have our bias, and after we have our bias, we choose our correct Q3 time frame, align ourselves with premium and discount. Then, after all of that has been established, we can look for trifecta liquidity, and eventually our draw liquidity, and so on. All right, so what makes a liquidity matter? A swing high / low becomes important only when it passes these context filters, right? Is it on the correct time frame? Okay, are you using the correct power of 3 time frame, which I'm going to go ahead and show you next? Are we using the correct meaningful gold bug location, meaning are we inside of a trifecta point of interest? Are we at a range low? Are we at a range high? Is that liquidity still active, right? Is it still there? Has it not been taken yet, in other words, right? And lastly, does it agree with our directional bias? Meaning if we're bullish, is the liquidity higher? And lastly, this is our drawn liquidity checklist before we actually get into the charts and show you how it's applied to actual candlesticks. So 1, what is the environment? 2, what is the directional bias? 3, what is the time frame that is delivering, right? What is the time frame that I'm paying attention to? 4, am I at a premium or discount? 5, where is the active trifecta liquidity? And 6, does the target match the whole thesis, right? Meaning, does it match my bias and what my environment is telling me? I need to know what invalidates the draw on liquidity. If you cannot answer these, do not force a target. It's simple. If you can't answer these, if you can't see these, you are the liquidity. All right, so here we are back on the candlestick chart here on the E-mini NASDAQ. And here we can see that we have multiple swing highs and swing lows throughout this chart, right? Some of you may say we have relative equal highs here. Some of you may say we have taken these relative equal lows here. We have this low here, 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 this high is here, this low here, this low here, this high, etc. Right? Which one is the actual drawn liquidity? Which one is the one at premium and discount, right? I can give this chart to 20 different traders, and if they've never seen a specific chart or if they have different strategies, whatever the case may be, you might literally get over 10, if not 20 different chart examples where they each one of them mark completely different highs and lows. And they might even choose different time frames, right? They might not even be on my specific time frame that I'm showing you right now. So that's what we have to go through our checklist, right? You remember the checklist. First, we have to determine our environment. What type of environment are we even in? Is this a graded environment or not? Okay. And then we have to choose our directional bias. Are we bullish or are we bearish? Right? And then we have to align ourselves with the correct time frame and then choose whether we are, or not choose, but determine whether we are at a premium or discount in order to enter a trade and then target some sort of trifecta liquidity. So every step that I just said, I'm gonna go ahead and just show you right now. First, we have to choose our environment. Okay, so here I have my trifecta program detector, which automatically tells me the environment of every single time frame that I have it assigned, right? So currently my program detector is showing that this is a B grade environment and we are bullish because we have more buy than sell and more discount, right? That's what the P is here, and we do premium. So I'm already favoring higher prices, right? So I've figured out my environment. My environment is valid environment to trade in. My directional bias is bullish. Now, the specific time frame that we're going to use, I'm going to show you now. So next, we have our time frames that we are paying attention to, right? So these are the 4 time frames that I personally like to look for trifecta liquidity, or in other words, buy side liquidity or sell side liquidity. Some of you might just call them swing highs and swing lows, right? So these are the specific time frames on the left, right? The 9D, which is the 9-day, the 1-day, the 81-minute, and the 27-minute, right? So these are the specific time frames that I'm paying attention to here. And on TradingView, if you go ahead and customize your intervals, if you're allowed to customize them, I already know that the 81-minute and the 27-minute are not the time frames that TradingView comes with originally, but you can customize those time frames to go ahead and add these 2 time frames as long as with the 9-day time frame, right? So now some of you may be new to Goldbach and are wondering what these mean, right? 6, 5, 6, 1 power 3 range, 2027 power 3 range, etc. Right? So these ranges are how we determine premium and discount objectively, right? Where is the premium and discount on this chart, right? So are we anchoring it to this swing low and this swing high to determine what's premium and discount? Was it this originally and then did it get taken over? Is it this high? Is it this specific high? Is it now this high, right? We need to determine which one of these highs and lows is where we're anchoring our Fibonacci to, right? So another one of the tools that I like to use is the Goldbach trifecta levels to determine my premium and discount objectively. All right, so here we have the Goldbach trifecta power 3 levels, right? These levels here, they see on the chart, they may just look like a bunch of lines at first when it comes to first glimpse, but it is really telling you the premium and discount of the current price range, okay? So remember, we're on the 81-minute time frame here, and we're using the 729 power 3 range. This is the time frame that I'm on. And down here, this is the dealing range, right? See how we have 729 low, which is L. That's what the L stands for. That's the 729 range low. Okay, so this is our range low. Alrighty, so here we have our range high as well up here, noted with this 729H, which is the range high. Okay, now these numbers on the side mark or represent percentages from 0 at the range low to 100%. So this means literally 7%, 11%, 29, this is 50, this is 71, 89%, and then lastly 100%. Okay, so anything above the 50 is to be considered premium, and anything below the 50 is to be considered a discounted range. Okay, so now we have gone through our first 4 steps. We know our environment is valid. We know which direction we should be trading with, which is bullish. We know the time frames that are assigned to each power 3 range. And then lastly, we know whether we are at a discount or premium, which is a valid entry to go long. And I get this question asked a lot about the specific time frames that I choose. No, you cannot change the time frame. These are the time frames that you have to stick to in order for this to be valid. Okay, so you cannot change these time frames. The time frames must stay constant.
We're making healthcare costs more transparent and helping you compare prices. Blue Cross and Blue Shield of North Carolina. Don't miss our biggest sale of the year with savings up to $700 on select adjustable mattress sets.
Thanks for joining your performance video. Scored almost back, and last year was frankly unacceptable. Mushy flew in my lunchbox. I know who's next to trade. You gotta step it up this year. I cannot try. Loyal.
5-minute healthy meals, hundreds of trade-worthy snack packs, no sketchy ingredients, and delivery on my schedule.
Let's start thriving, Mom. Join today and get $60 off.
Free yourself from prying eyes. Ask privately with Duck.ai.
There is so much NFL on ESPN right now. It's disgusting. I love it. Monday Night Football's on. The pregame and postgame are on. And then like
This is the definition for your trifecta liquidity. Go ahead and screenshot this and have it in your notes. So trifecta liquidity are specific swing high and lows that form in specific power 3 time frame assigned to each dealing range. They must form inside of the green zone or the red zone in order to be valid trifecta liquidity. Not every swing high or low is valid. Location and time frame matter. Okay. The formula is the power 3 time frame plus the green or red zone in order for it to be a valid trifecta liquidity. This is the main takeaway for this specific slide. Now that we have the specific definition, let's go ahead and get back into the charts to show you some real world examples. Now here we are back on the same chart that we went over previously without any of the indicators on there, without the trifecta indicators on there. Just to show you guys an example of how much having the point of view of the trifecta indicators and the levels on your chart and the detector actually help. Right, so we go ahead and play this forward without any of this stuff on there. Most people would be targeting these highs up here and then these highs up here, right? Which wouldn't be wrong for any one of these highs because they are technically considered buy-side liquidity from an ITT point of view, right? So now let's say you were targeting these final highs here, which when we go ahead and look, we can see are pretty relative equal high pair, right? Let's say you enter a trade here, try to take this long, have your stop slightly below these lows, and trade above that would activate you and you'd be targeting these highs. Now, initially, you'd be right about the direction, but then if you held on to it for too long because you don't know true premium and discount, right, you would eventually end up taking a loss here on the specific trade. As you can see, it does end up coming below these lows before finally continuing to go higher. Okay, so now let's go ahead and go back to the indicators point of view that we had before. So when we go ahead and put back the indicators that we had prior, right, remember that the green zones are where range lows and highs should form, right? in this range, this is a range low, and this is a range high. Once we get above this range, this becomes our range low, this becomes our new range high. You look at exactly where the high forms for this specific example, okay? And it does take the high here, right? But why does it specifically reverse after taking this high and not this high and this high or this high, right? Or even taking these highs up here, okay? So now I'm going to add one more indicator to the charts, and I'm going to go ahead and go back to this specific time on price. Okay, so here we have my third indicator that I use on my charts, and it is the trifecta liquidity indicator, right? So this indicator literally points out the trifecta liquidity swing points, okay? And I want you guys to notice how they are inside of the green zones, inside of the red zones here, green zone here, and then we have this trifecta liquidity here. Notice how we take this liquidity, reach a range high, and then form a type 2 CSD that you can see here, noted on the indicator telling you that it is now in a sell program with that here. And if you hover over it, it even tells you what type of CSD it is, but it's a type 2 CSD. That is one of my CSDs that I created. If you're new to this specific channel, I have a different video that goes over my type 1 and type 2 CSDs. I will link in the corner of this video right now. So in this specific example, you could have either taken the long here and knowing that you can target this high and this high here, right? So let's go back and show you that specific example, right? So you want to be buying anywhere below the 50%. Let's say you were to enter there, you would have your stop below the green zone. You can target another green zone or a red zone or the opposing green zone, right? That is my green to green model. You would have either full take profit there, and obviously in hindsight, we can do see that this does end up playing out. And notice how the indicator automatically changes itself once the targets have been reached. And here, for those people that like to say they like to enter on liquidity sweeps and a CSD, well, this is the most objective way that you can determine a liquidity sweep, right? You know exactly where it should be. It's not just every single random swing high, okay? And yes, they are right about these being liquidity up here because the indicator is showing you that they're liquidity, which does end up getting taken at a later time in the future. But here goes the liquidity sweep. There goes your CSD. You can enter shorts here. Again, with your stop at the green, targeting the next green. Notice how we have this swing low here inside of the green zone, making it a valid trifecta liquidity and a target that you can reach for. And there you have it. It does eventually get hit. And notice how the retracement pulls back to where above the 50% because highs should form at a premium. And then down here, lows should form at a discount. All right, so here we are on another example on the 81-minute time frame. This is on August 11th on the 2015 candle on the 81-minute time frame, okay? I want you to take your attention to this specific low here, okay? At this current moment in time on this specific price, the higher time frame was leaning to continue higher on the S&P 500, so we were taking this move lower as a manipulation lower to form a low. Again, is it this low that needs to get taken? These lows, these lows? Which one of these lows is the one that needs to get taken? Well, this specific low here that I have indicated is a trifecta liquidity, okay? And how do we know what to target? Remember, we have our liquidity inside of here. That's inside of the green zone, all right? And then we have previous day high inside of here that's also inside of the green zone, okay? Now let's drop down to a smaller time frame so you can see how the 27-minute also can happen. All right, so when we drop into the 27-minute time frame to try to get an entry on a specific price action, this was a low that we saw on the 80-minute time frame here. It's a swipe there. That's an actual liquidity swipe, right? It's not an opinion-based liquidity swipe. And here on the 27-minute time frame, you can see that I was switched to a buy program on the NQ. So again, simple entering inside of the green zone and targeting the next green zone. And we have that 729 liquidity inside of that green zone that we target. All right, where's our stop loss? Below the green zone that we're entering inside of, right? Very, very simple. I'm gonna go ahead and play this forward. You can see that a green to green does in fact play out. All right, so here's the example on the 27-minute time frame where you could have caught a very hardness of your trade here, even in trading there, like I said, stop below the green, targeting the screen, that is above the 3-hour trade. Okay, so here we are on the daily time frame on the E-mini NASDAQ chart again, and we're currently inside of a range below, which is the green zone. Okay, now just because we touch a green zone doesn't automatically mean that we have a trade, right? We have to wait for some sort of complete. These are trifecta liquidities noted on the 2097. So when I hover over the liquidity indicator, it literally tells me the time frame and the power of 3 range that the liquidity is on, right? So now that is our liquidity swing. So now we need to wait for CSD. But notice how this says sell, and it's currently telling me that it's in price distortion, right? So I need this to switch to a buy pattern. This is the same indicator, but I have it in a different point of view, just to see, so you guys can see multiple views about the indicator here. And then we have another liquidity still resting below the range here. Okay, so now we have taken that liquidity there being noted on the 2097, and we have a CSD above the green once again. And now that we have everything that we need, not just the liquidity sweep, but the CSD as well. Again, entering at the green, targeting the next green, your stop loss slightly below the green. I'm going to go ahead and pay this forward. You can see that the grade was in a B grade, 75% bullish, and that's why we had this low resistance liquidity around here after the liquidity sweep. So when people are saying that they like to trade liquidity sweep followed by a change in state of delivery or breaker structure or market structure strip, if they don't have an objective way to determine their CSDs just like this, then they're just pattern trading. And then they're no different than head and shoulders trader, full flag traders, where
Look at the people. Look, summer baseball. The food is over the top.
Hello everyone and welcome to another educational video here on my YouTube channel. So for this specific video, we're going to be going over a specific portion of price action, which is roughly 200 points. And I captured almost the whole 200 points myself in a specific range here from the low to the high, exactly where you're seeing it. So this is the screenshot of the actual execution that I took on that specific day. You can see the date on the charts. So you know that I'm not talking in hindsight and that I actually took this trade and that I can apply this on in real time. So before the market opened on this specific day, I already had a directional outlook for the NASDAQ on this day. If I didn't get that direction, just because price was sitting at a specific low bot level, the level showed me where to pay attention to, but the confirmation comes from my CSDs that I created for myself. So I have 4 CSDs that tell me when there's a buy program and when there's a sell program. In this video, I'm going to show you the difference between having gold bot levels and actually knowing how to use them. So many people have the gold bot indicator already and they have the levels and they're familiar with the level. But some people may think that there's too many lines in the indicator, right? There's too crowded. And some traders don't know the exact discount and premium levels. They think when price reaches a discount level, they think it's an automatic buy. They think when price reaches a premium target, that has an automatic sell. Some enter immediately as soon as the level is touched, right? Some like to scalp different levels. Others are constantly changing their bias after every reaction from a specific level. The levels alone don't tell you much program is active, right? A gold bot level tells me something could happen, right? The CZs tell me what is actually happening. I can want certain things to happen from the gold bot level, right? That all once price to reject from a specific level, but the CZs are telling you what actually happens. And not only that, but discount is just location management. Discount by itself is not permission to buy, and premium as well as just a location pricing. Premium by itself is not permission to sell. Okay, so when analyzing price, we're going to ask ourselves a few questions. What daily range am I currently trading on, right? What buy and sell programs are we in? What confirmations do we have? Where's the invalidation? And where's the next draw on liquidity? Okay, again, to repeat, what daily range am I currently on? Which one am I paying attention to? What would confirm a buy or sell program, right? And what would invalidate a buy and sell program? And where is the next likely draw on liquidity? So if I can't answer all 4 of those questions, but I don't have a complete directional bias for the day, and I only have lines in my chart. Just like everyone says, at that point, it is too bad if you don't know what you're doing with the actual bot levels, right? You have to understand what the levels are doing and what they're there for to do for you. The levels can give you an objective way to view price action in, you know, how to. Okay, so for this example, I'm on the 81-minute time frame on the NASDAQ chart, and I'm on a 729 daily range because that is the daily range that I have assigned to the 81-minute time frame. Okay, and this is the day as soon as it opens up. So first thing you want to do is ask yourself, am I in a buy or am I in a sell program? So I have an indicator that makes that super easy. So I created an indicator for myself that I coded all my rules into it, and it does all that for me. It sees these, the validation and the drawing, all of that is in there. And I even added an environments detection to it. So it can tell me whether this is an A setup, B setup, or C setup, depending on the daily range that I'm paying attention to. Okay, so here are the indicators that I created for myself. I have the program detector on the screen right now, as you can see, which is the trifecta HQ detector. And I also added the liquidity one that maps out the Tuesday high and stuff like that. That also shows the day one of the full bot monthly partition, meaning that June 3rd is the first day of the full bot monthly partition. And it also maps out the Zurich open, which is the opening price for the day, and things like other stuff. So currently, on this specific example, this specific daily range is in the A setup environment based on my protocol. Okay. So prices in this specific grade, this specific daily range, right? I know my invalidation because my indicator tells me the invalidation, so I know where prices should be. Not close underneath. And you know, it draws a liquidity, which up here. So in the 729 daily range, that 23% was the draw liquidity. So as long as you can insert inside of this range though, that is a valid entry. Okay, so literally it doesn't have to be all the way down here, which is where I enter from, because it rejects the last line of defense. You can see when I hover over, you can see that it's the last line of defense. So now the actual entry that you saw on the chart was on the 27th time frame, just to show that I caught it specifically at a dip level, right? But the dip level essentially the same as the last line of defense on the 729. Again, I repeat, the last line of defense on the 729 will be a GIP or a dip level of 1 million range underneath the current one that you're to. So when we fast forward price, there was a huge rejection. So I'm gonna go back and just add the market order there just for video purposes. And we should not close underneath that, right? That's where your stop loss should be based on the indicator. It can look through it, can't close it. We can have your stop loss there for safe keeping, or you can have it there if you need to be conservative, right? The hindsight, obviously, in specific example, you have seen already that it does not touch that. So we can keep that there. And the take profit would have been 23%. So that's literally telling you where to take profit, where to put your validation, and telling you that you can insert inside of a specific daily range. And as you can see, fast forward, it doesn't take too many candles to go forward. Now, this is the 81-minute time frame, so it is majority of the day. But I had no problem holding that specific trade. As you guys can see, it does end up getting full draw on liquidity, and the indicator starts to update itself as it's going, okay? Which is a pretty cool feature about this. So let's go over the requirements on why I was able to see this. So now, if you go to one of my previous videos where I show the type 1 CSD, just to go over that real quick, a type 1 CSD is when we reach the range low, right? And we close above 11%. On this specific candle here, we close above 11%, which made the bottom of the range low the validation. So as long as the price did not invalidate this 89%, we were in a buy program. So that means that before this day even opened, I literally knew that the direction for this specific day should draw higher till we reach bare minimum is this kind of flow gate. Because when we first reach these flow gates, we automatically should reject them before going through it. Okay, so but we just simply say, okay, okay, reject price until you actually price it. But in the beginning, you should be expecting sales for it. And vice versa, when approaching a flow gate from above, I want to see rejection away from it at the beginning before it actually goes through the actual level, right? Because that alone doesn't give you a setup. It's the confirmations of CSDs that tell you it's more than likely going to reach the next gold level at 17 and then the next gold level at 23 once we close above this. Okay. We had already touched the 17% on the specific candle. I mean that the next draw liquidity was 23%. Okay, and then notice how at that current time, this was the all-time high. How am I able to tell you where price is going to reject from or where it's going to go to that all-time high? This is my main question I have. I don't believe robot levels itself. I don't believe that this is where true highs and lows market. Robot is the true premium and discount. So again, just to go over that, once again, the type 1 you can touch is a wick or a body at the range level, and the confirmation must be a body. Notice how here it trades above, but there is no body above it. So here we have the body close above. Okay, so this is what it looks like on the 27 time frame, and then I'm going to go ahead and take you through that and show you how you can manage your stop loss on the way up using the gold body levels and steps. Okay, so here we are on 27-minute time frame. On this specific daily range, we're using the 243 daily range. And as you can see on this specific daily range, the invalidations and the draws and liquidity are also the same on the specific time frame. So no matter what time frame you're paying attention to, the invalidations are still there if you want them, or you can have them removed just to focus on any specific time frame that you're on, which is a really cool feature. So here we switch into an A grade setup. Now all the daily ranges are saying the exact same thing, and that is where you find your low resistance liquidity runs. Okay, if you take anything away from this video, take that away itself. Stacking your buy and sell program is going to help you more than you can possibly imagine. So now here, the invalidation starts to move up. So you just trail your stop loss with the invalidation as it goes. It really tells you what to do. Now you have a risk-free trade here. And every time the invalidation marker moves up, you just move up with it. You can see here, let's move this over. The draw on liquidity starts to move up as well with it on the 243. See how that's changing, how it's not static, it's dynamic. And again, now you can move your stop loss forward. As you can see here, the indicator automatically does that for you. So now again here, it can work through it, but it can't close below it. So you can have it at the invalidation or slightly underneath, whichever one suits your boat. And there you have it. So notice how not every visible gold block level is not automatically a current target. It depends on the current CSD that is in play that indicator moves up, right? So it's not every specific one that it touches and then all of a sudden it's going from 1723, 2935, so on and so forth, right? That's not the whole gist of the actual indicator itself. So I hope you liked this example of this specific trade breakdown that I'm doing here. I'm trying to be more detailed on this video to help as many people as I possibly can. And again, I take anything away from this video. Stacking your dealing ranges is going to help you tremendously. And just because one dealing range is in itself floating or bipolar, that does not mean that all of price has to reverse. Or if they're saying opposite things from each other at the current time, that does not mean that the algorithm is broken or anything like that. But it just means that one is manipulating over the other, right? That is another reason a lot of traders get confused when looking at gold bot or trying to figure out what direction price is currently going in, right? If you don't know and if you have any contradictions, just step away and go touch some grass. So again, gold bot levels on its own are not automatic entries. The correct range is what gives you the structure to pay attention to for that specific time frame, right? If these confirm the program, the invalidation tells you when the program is no longer valid, and the draws on liquidity tell you your price is more than likely going to. So before you take another gold bar trade, ask yourself, what program is active? what invalidates it, and what is the next draw on liquidity. And if you don't have those answers ready, you don't have a trade yet. So if you like this video, go ahead and comment below, type 1 CSD, and I'll go ahead and make more videos about this. Or go ahead and type 2 CSD if you want me to make a type 2 CSD video going over it in detail just like this. As always, good luck and good trading, homies.
School is where germs pop up. And now with your help, so does Lysol. Because this year, you buy Lysol wipes, we donate Lysol wipes to schools in need, helping to protect up to 60 million kids.
Hello, everyone, and welcome to a little midweek update for my weekly outlook. And so far, it's coming to fruition, as you guys can see. So now, in my opinion, well, not even my opinion, based on my protocol, my objective rules, the CSD video, if you guys go back and watch it, this is a type 2 invalidation of a cell program to now a buy program, right? So we had reached EQ. Let's go back here. This specific candle here on Friday, the moment we closed above this discounted range here, this whole range became the support. And so we targeted the rebalance zone when we went ahead and did that. And we chopped around in the rebalance zone, right? Here on Tuesday, the 19th of May, we closed below the 23%, which technically invalidates the buy program, right? So this specific candle here turned it into a sell program. But there's one thing that I want you guys to pay attention to. It taps into the 11%. So the moment it closes below the 23%, the next target are the 17 and the 11, right? And then when it touches those, then it goes so on and so forth. But this is a range low. This is where lows should form. And I also want to notice that I don't have any more SMT. I'm not even paying attention to it. There might be some SMT somewhere in this low, but I wouldn't be surprised if there is, because it's more of the trifecta levels themselves, the programs that they offer that are you should be paying attention to, right? So once it taps the 11%, it has to close above the 35%. So 11 to 35, very straightforward. Taps into 11, body closure above 35. And that's exactly what this candle did with tons of strength, right? So now the invalidation becomes at 11% itself and the low. It can come back, and if it closes below the 23%, I would be cautious and just wait to see what happens in between the 17 and 23. But the best case scenario right now, which is exactly what's happening, this kind of opens low into the discounted flow gate. 35 and 29% have to hold as support. Once that happens, the next target that we're aiming for would essentially be the 41%, but we already tapped that. And then it's 47, 50, and 53. And if this original Einstein model is going to hold, it should reach the 65%. And coincidentally, we have a high engineered right at the mid-level in between the 59 and 65. So in my opinion, once we tap into the 50% at the completion from A to B, I would then wait. Maybe if you're in a trade, if you don't exit fully at the 50%, you go on and continue 30 to 65 if you're a swing trader, right? And now what's one way that I could have seen this coming and entered off of that? I would go one power 3 range lower. From the 2187, I would go down to the 729. Alrighty. So if you guys remember my video, directional CSDs, like directional bias, right? My buy and sell programs on the 81-minute time frame. So if you guys haven't watched that video, go ahead and watch that video. It's in my playlist below. So now, here is today's candle, the 1612 candle on Wednesday, the 20th, on the 81-minute time frame, closes above the range low. So this candle turned on a new buy program. Here, it was in a sell. This one invalidates the sell, which is to a buy program. That now means that this entire range low is our invalidation. The entire range becomes invalidation. And then the first draw is a 23%. And as you guys can see, we tapped into that and touched it perfectly. So now that we close back above it again, we have like a second type of CSD. Here, it comes back to the 0 and closes above 11%. That is the standard CSD that is inside of the trifecta book. So that's the regular CSD that Poppy gives, what I call the type 1 CSD. So 0 to 11%. That's 2 and 1 right here telling you, and I believe it's going to form a BISI through the 17%, which is another tall tale that is going to continue higher. But now that we reached the 22%, the next target becomes the 29, and I currently have it at the 35% because we already tapped into these, came back. It's kind of very obvious that it's going to hit that 35%. So yeah, that's me calling it right now. The low that we formed 2 days ago is going to be the low for the rest of the month, and we're going to continue until the 17th day of the monthly partition. So if we go back, so here we go back on the 2187, this is my daily time thing. Wednesday, the 27th of May, is the next date that I expect the high to form for this monthly partition. And then once we do form that high, some at a premium for the rest of the month, you can expect some sort of lackluster movement. But yeah, that's me showing you guys live price action. This isn't delayed. And I also executed on this exact idea. Go ahead and show you guys that right now. All right, so here we are on the live account, my TradeAvate account. You guys can see live price action hovering over this market open. And I'm going to switch through that. Yep. So essentially, you guys watched my video. I had given you guys before the EQ to EQ model. That's my specific model. And if you guys see anyone else trying to use it, this is my specific model. If anyone says otherwise, on the trifecta EQ to EQ, this is my specific model. I wish I had an account where I could swing trade this. I would have been holding from here. So this specific day gave a perfect scenario to enter during Asia. And as you guys know, the earnings cover today, I was expecting the video to have bullish earnings. It's just kind of very obvious to me. I almost got in right at 0 that I wanted to see a specific path aligned. Yeah. Switching time frames, moving it around. If you guys go into a fractal range, you'll see the CSD right here. The moment we close above this high here, comes back, entry on that straight away. And I'm targeting the rebalance zone at the 41%. Yeah. Not only am I predicting it, following it in advance, I'm executing it. I'll show you guys as possible. All right,
Grandma was baking cookies. She'd let you lick the batter. Cookie dough.
Good thing that's 15 grams of protein.
Built part.
Without a doubt, the most famous trading indicator right now is deep trades. Since one of the world's top scouts, Bobby Valentini, started using it around the world in podcasts and YouTube channels all over the internet, people are literally going crazy about it. In this video, we're going to see exactly how this tool works, how to set it up on the deep charts platform, which is exactly where Bobby Valentini uses this. And if by the end of the video you decide you want to have the same indicator because you find it useful, we're now running an Easter sale that you can get deep charts at 30% off. It does come with a full course of containers to learn how to rank these types of effects. professional tools. Plus a live session per week with Fire himself and all included in your deep trust subscription. But we're also going to see a cheat sheet on how to use this trades and the four most important patterns that you see in the big trades and power trades. Without further ado, let's meet deep trades. As we open our deep trust platform, you're going to see the main bar. And if you click on new and price chart, you can simply, for example, select in the ES, the E-mini S&P 500, or the NASDAQ future. And the NASDAQ future is where you mostly trade. And instead of just, setting it up yourself, you also have the ability to click on templates right below here on the full version, click Fabio Valentini, and directly select its deep trade indicator. Let's see how that looks like. Let's click no. And as you can see here, our chart now has these amazing bubbles. And now we can start tweaking a little bit with the settings and maybe see them a little different, right? Let's see if we have another template that it's cool to mention. Yeah, actually, we have the deep trade review, which is a different one, slightly different one that also tells you the number, how many contracts were traded in that big trade bubble. And let's first understand how they actually work.
Objetivo cumplido, mi hija lo celebró. Mi primera vez viendo una café para mí.
Hey, Spectrum Internet customers, make the move to Spectrum Mobile and start saving today. How? You can try it free for a year with no contract and no commitment. Plus, we'll pay off your phone balance up to $2,500. Spectrum Mobile runs on the network that covers 99% of the population. Start saving today. Switch to Spectrum Mobile and get free mobile service for a full year. Go online or visit a Spectrum store today.
Oh, cada vez más cerca del agüita, qué rico. Y miren esta belleza. A mí demasiado como te resalta ese bikini, el color de queda espectacular, ¿no, abuelita? Mi primera vez en Marbella, donde se respira el lujo, donde vas viendo carros impresionantes, Lamborghini, Ferrari, altos yates. Bueno, qué gusto va pasando uno por atrás. Y bajó el vídeo, ¿no?
bajó la ventanilla y me dijo, "Sube".
Tenemos un jueguito especial solo para vosotros. Y es que vamos a competir palabras andaluzas contra palabras venezolanas. Pero la que pierda va a tener que quitarse la parte de arriba. Pero eso al final.
¿Cómo están? Bienvenidos una vez más a mi canal. Hoy les saludo con esta vista espectacular y es que acabo de llegar al sur de España. Estoy en una ciudad preciosa que desde hace tiempo quería conocer. Estoy en Málaga, mis viajeros, y muy emocionado porque no estoy sola. En esta oportunidad vamos a tener una guía súper estrella, bellísima, que además es española y además nació acá mismo en Málaga. Quiero presentarles a Laura. Aquí somos. ¿Cómo estás, Laura? Muy ilusionada de que estés aquí en mi tierra, que yo soy andaluza, y qué ilusión me hace enseñarle a Vero, que es una modelo, un bombón de niña. Mira que sabe todas las tradiciones y que ella se conmigo compartir este momento, estas vistas. Mira, tú eres malagueña. Me dicen, aquí se dice como boquera. Aquí se dice que somos boquerones. Boquerones, sí. Ustedes lo habían escuchado, yo nunca había escuchado eso. ¿Por qué boquerones? Eso es porque comemos muchas sardinas. Y las sardinas son boquerones chiquititos. Entonces se dice que somos boquerones. ¿Y me vas a llevar a comer un poquito de eso? Por supuesto. ¿Qué más?
You want to see the 10 cent.
Be in those other accounts. And so by rotating it, like you said, it's $50 at rotating it, like you said, it's $50 at a time, $40 at a time, instead of doing all of them on this one account. Then each time I go to take that next scalp, I don't really have to have that stress on giving back those profits I already got. So I think that makes sense, and I'm gonna I'm gonna try to practice that maybe the next time here.
But here's what I would do, as a older brother, friend, mentor, whatever. Try to keep your accounts consistent, meaning the same amount. Like if you're trading 100,000 account, and then try to have minimum 3, and just go back and forth, back and forth, back and forth. And then when you see yourself really, doing very well across the board, then go buy 5 accounts and link them and treat them as one, right? And then you have your 3 plus the 5 linked, right? So how big size do you use? Depends on volatility. I don't know. 10 micros? No, I don't trade micros.
Yeah, we don't even have to get into nanos. We tempted to bring up nanos again, but I think we talked about it last week.
I did. I don't remember. I'm not trading on. Look at its gold drop. Look at its gold. I start covering below 45.5. Oh, it's gonna get smashed. There we go. Guys should be trading gold and Bitcoin. Let's go. Get in there. Oh my God. Oh my God. Gold has dropped 5. Come on, get in there, Luna. Oh my God, $6 gold. What a beautiful bear flag, double red short. Look at this Bitcoin. It's dropped. You're making new highs here, non-confirmation. It was a short. Look at the MACDs, non-confirming on the 5. God, I could trade everything.
Yeah, I had a gold trade marked out this morning where I'm looking for it to get below 45.33. And then I was thinking that I could maybe send it for a bigger move down They're like pretty clean range down from where we moved up yesterday, which I actually had that long yesterday before it broke out. And so now it's going to kind of short it back down towards that direction.
I took this short, the 15's negative, the 30's negative, the 60's bullish, so I have what's called a sell disconnect. When the 5 reversed to sell here, you can take the scalp long, or the better pattern is what's called the double red short in my work, my methodology. You short the first bounce on the 5 minute. I call the brains perfectly 46 up to 52, 53. The high here is 48. And it just dropped 5 points. So you're scaling in 46, maybe 47 and a half, or maybe 46, 48. Unbelievable. Okay. That's a great short right there. So Bitcoin, if you're trading pushed off non-confirmations, this is about 250. Guys, it's so, look at this gold. Adam, you get the short. Adam knows my work. Where's that? Adam, get in there. Okay. You have to first part stuff. Like, I use dollar stuff. Sorry, I use dollars.
So by dollar stuff, you mean like you have a set risk tolerance? So like, that's exactly what I was doing for these scalps that I just did. I knew I wanted to risk at most $500, and with the current volatility and ATRs, what I was looking at to judge that, I don't think it was ATR, but I was looking at 10 points on ES. I'm like, right now, I don't want to risk more than 10 points. Like, if it goes 10 points, I'm very wrong. So I was risking $500 for a mini contract. Is that what you just by a dollar per stop?
If you just think about it, where's the bear? I'll give the bear. There you go. That's my bear sound. The gold dropped $6 just now. But think about this, right? If you could watch Bitcoin and an index and gold, just more than enough opportunity for you guys to learn. Now that was a pattern just now. That wasn't a scalp. That was a pattern. It's called a double red short. 5 minute time frame, reverse the sell here. Okay. Correlate from 15 and 30, and then you short. That's a beautiful bear flag. That's not stopping us without them. What is this? I don't need to say every question. Every order that you do as you're trading, you should have either a dollar amount that you don't want to lose on a trade. Okay. And I want to run one more thing for the guy. And I don't put buy stops in. What's my favorite pattern? Yeah, I'll show you a favorite pattern. Let's do Tesla. It's one of my favorite. Okay, one of my favorite.
Great question, though. Thank you for asking that question. I'm excited now.
Okay, so Tesla reversed the buy yesterday on my work right here. The yellow dots into the Cayenne, very bullish. I bought pullbacks, then I bought this monster pullback right here. Look at this. Look, I had the room, everybody, a lot of people bought this, the falls. Now, again, when you're trading options, this is when you can trade options. You're trading patterns, okay? Let's see here. So you got this long, beautiful bull flag, below 346 and a half. A pattern usually lasts up to 8 bars, but if you even got it here, it ran almost $3. So again, this is a great pattern here. The 60s reverse correlated with the 30 and the 15. Then you buy this beautiful pullback on the 15 minute time. All right. I can balance you with another one. So I can see here, like put out. There's another one yesterday on the 30 minute here. 30 reverse to buy right here. I took the shorts, waiting for the pullback, got the pullback right below 170, 173.80, and then it ripped at the end of the day, about $3. So these are one of my favorites. Look at the NASDAQ drop. Oh my God, Bitcoin just dropped 300. Guys, you guys, we do probably a couple hundred trades a day in my I mean, nonstop, right? I said I'd short the NASDAQ up there from 55, 60, right? Anyway, there's so much opportunity. Oh, one last thing I want to talk about before if you allow me here. When you're trading the NASDAQ, right? And you have to learn how to trade each asset. So NASDAQ trades a lot differently than the S&P. Gold trades a lot different than NASDAQ. Right? Obviously, being a Bitcoin trades a lot different than a lot of other things, right? So what's important to really understand, okay, oh yeah, I'm a hyper scalper. Oh, forget it. Is yeah, but you know what? You bring the rest pretty careful, right? Uh, actually, it was more than 14 points. Okay, I said 55 to 60. What did I get that? So I can, what did I get?
I got it down to 27.
64, 26. That's about 40, about 35, 40 points. What time? What comment is there? 6:30. What do I care? I'm up at 4:30. So it's important to realize, I guess I had a guy shorting the NASDAQ every 5 points. And I must have told him at least 3 times, that's not the best approach. You need to scale based on volatility every 10 points or every 12, 14. So if I'm calling a 40 handle range, right? Let's say I call the range 50 up to 90. I'm gonna go to bed midnight, 11:30. And then let's say I call a range 55 to 95, and you get short at 55, maybe the next entry is 70 or 65, depending on volatility. Maybe the next entry is 85, and you want to go 1, 2, 4, or you go 2, 4, 8, whatever you want. Okay. So I think it's important to realize that how you enter your orders on the NASDAQ. Okay. And I think I've talked enough. I would short this gold here again, 49, 29 and a half, up to the 56 and a half range. Okay. Anyway, I think I've talked enough here.
And looking at gold here, gold is keep it picking back up to maybe some of these entries you're talking about.
The Meats family has finally gained a member. Meet Applewood Smoked Ham. Smoked is their middle name. 2 for 7 Hammondsless melts. All we have the meat.
Whether you're a professional or just love getting hands-on with your own projects, or great on your quality hands backed by a lifetime guarantee. Your hands doesn't.
Hello everyone and welcome to another Goldback video. This is going to be an exciting video to do. This video today that I'm doing is going to be different than the weekly outlook. It's going to be a video about Goldback time, everyone's favorite topic. And I'm going to show you how you could use Goldback time to predict highs and lows of one before they even happen. So this is the daily time frame currently on the E-mini NASDAQ September contract, and it is now July 1st. And the lows of June and the high of June are now in. Let me go ahead and show you those lows right now. All right, so I've added the June low and the June high. And I've also added a few horizontal lines to the chart that I will be explaining that have to do specifically with Goldback time. So just to show you guys quick proof that I was able to call low of the month the day it happened. Literally the day it happened. All right, so here we are in the man himself, Happy Laka's private Discord. This is the 4G member section. So this is his private section of his Discord section. So where the members get to talk. This is where you get to ask Happy questions. a membership that I am a part of because I am one of his students. Everything here is all credits to Happy Laka for finding this back time. Or what I use as far as going back time goes. So here a message that I posted on June 9th, 2026. And as you guys can see, this is me. Hover over, this is my logo. All right, this is the poetry member section. And I say, I believe the low of June is in if day 7 doesn't invalidate the current BP, which is by program, on 2197. I expect expansion until day 11 of partition, calling it here in advance so I have proof the month is over. And now the month is over. So let's go back to the charts. Well. Let's see. June 9, 2026 was when the low of the month was formed. How did I know that? How was I able to call that in advance? The answer to that question is Goldbach trifecta and the CZs that I created based on Happy Laka's books that I've read. We all read the same books. We all read the same knowledge. But those CZs are my findings, my work. He himself has given me credit for creating the CZs that I created that are 100% objective. Once they're in, I have specific rules to set everything. So I'm going to go ahead and add a little bit more ellipses to the charts. Okay, so now we got a little bit more zoomed in here. And as you guys can see, I've added the monthly partition date that the horizontal lines align to. As you guys can see here on June 3rd, we have day 1 of the monthly partition. I know most people like to use the obviously June 1st for the opening of a monthly partition, but everything here that you're seeing on this channel is based on Goldbach and the findings of Happy Laka. So that means that based on Happy's findings, the true monthly open for June should align to the number 63. And I'll go ahead and explain that now. All right, so here are the Goldbach monthly partitions and the numbers that Happy uses to derive each specific month. So now, when you're looking at these numbers, you should automatically think that they are all divisible by the number 9, which is exactly correct. So these specific numbers are the numbers that Happy uses for each Goldbach monthly partition. And one thing that I want you to do visually in your mind is separate first number for the second number up until you get into the 3 digits, which will change. But for this first 9 numbers, there's 12 in there because there's 12 months. Each one is assigned to a specific month and date. I'm not all headed out now. All right. So here are the 2 Goldbach monthly opens for each specific month. So what I want you guys to pay attention to here is that the number on the left is considered the month, right? You have June. So the numbers on the left are representing the specific month, right? So January is 1, February is 2, March is 3, so on and so forth. We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 in the month, right? On the right side, you have the date section. 8th day, 7th day, 6th day, 5th, 4th, 3rd, 2nd, 1st. Those start over from the number that we hit here, which should be 9 above 8. Let's start over here. 9, 8, 7, 6, so on and so forth. Right? So now the only time these specific days change is when this, let's say, for example, on June 2nd or something of that nature is on the weekend, then it would just be the following day. So you say you're looking at this video 2-3 years in the future from now, and you're trying to figure out the true monthly open for Goldbach and a specific day that you're looking for, which could be another example could be March 6th or February 7th, since that month has a shorter month. It's possible that the 7th is on the weekend. All you do is move it over to the next following day. So those are the rules for that specific month. So that is why 63, which is June 3rd, is the first day of the monthly partition for Goldbach. So now that I've explained that, and now you have your visual representation, which you should also write these down if you don't have a book. I do recommend you buy a copy of the Lockout's book. It'll clear up a lot of things for you if you don't already understand this. And if you want to learn how I trade Goldbach time and use this for my trading and my full model, you can go ahead and sign up to the link below to sign up to be part of Trifecta HQ. So now let's go ahead and get back into the charts. All right, so here we are back on the charts. And again, you're probably still wondering, how did I know that June 9th was going to be the low? So the first thing that we want to do is look at June 3rd, which is the opening first day of this monthly partition. And then we want to wait for June 3rd to give us some sort of hint or clue on what direction we could be doing. So as you guys can see, June 3rd was a huge candle dollar. And at the current moment, we were at a premium of this 21.87 daily range. So, in my opinion, price is going to go higher for the summer months, all the way leading up into October, November time, which is what I'm expecting for this specific year, right? So, in my opinion, this specific day was telling me that NQ was seeking some sort of discount, and that's exactly what it did. So, you're looking for some sort of sign of a like form. And on this day, which was June 9th, we had this candle reach the range low of the price and close specifically above a 35%. And if we go back and look at my video on CSDs, you'll go ahead and see that this is a type 2 CSD. I'll have the video linked up here on top, so you can go click on that just to watch that if you haven't watched it already. But basically, this is one of my CSDs that I've created. It has to reach the range low, specifically the 11%, without reaching the 0% or the 100. Right? It could be the low or the high because they mirror each other. So it reaches the 11%, closes above 35%. For me, that is a type 2 CSD. And if you go and remember the message I wrote on Discord, I wrote after that candle had closed and price was coming lower. Literally, as it was coming lower, I specifically said that I believe that the low of June was in based off this one candle. And day 3 coming into a discount. I said as long as day 7 doesn't invalidate this low, which it could have taken the low, touched the 0, even touched below it, as long as it didn't close below the 0%, which is the invalidation for a type 2 CSD, which again, if you go in that video, you'll see me talk about it, give examples and everything. So go ahead and watch that video. But I specifically said, as long as day 7 didn't kill this idea, which is all that the Goldbach time is doing for me, right? Day 3, day 7, day 11, day 14, they're not automatically supposed to reverse. They can form swing high and swing lows, right? That's 1. 2, they can be part of the swing high or swing low.
En la escuela los viernes aparecen y ahora con tu ayuda también Lysol, porque este año cuando compras toallitas Lysol, donamos toallitas Lysol a escuelas necesitadas, ayudando a proteger hasta 60 millones de niños.
Trim, edge, and shade with Philips Norelco One Blade. One tool for all you need.
There's DNA. Then there's heavy duty DNA. HDNA.
Rest doesn't hold you back. It powers your rise.
Or they can reach a premium or a discount to then later on form some sort of CSD that you're looking for. Or it can complete the move on each one of these specific dates. So there is no hard set rule when it comes to the monthly partitions. You just want to look for these specific dates to now fit your narrative that you're forming and that you're coming up with using Goldbach trifecta levels. And this was a perfect example. June 9th creates a CSD. Day 7, which is the CE between 3 and 11. So this is a CE day. This is a CE time between the 3 and 11. If you do not know what that is, you guys can go ahead and buy Hoppy Lock's book. He goes over that pretty well. But yeah, again, we can't keep giving enough credit to Hoppy Locka for this and the examples that he has given in his books. So here, day 7 forms another type 2 CSD, which is just super telling you that we're going to reach at least some sort of premium, but which could be this premium low gate or the range high, which in hindsight, as you can see, form that high. Correct? Day 11 was here, and day 11 formed a CSD. Again, from the range high, once we close below, day 11 was a part of this swing high, and we have a type 1 CSD here. Actually, the type 1 CSD was here, but day 11 is part of the swing. So now again, the Goldbach monthly partitions are giving us another hint, right? In that same video, this is my type 1 CSD. The same videos that I was giving on YouTube for free, which is just 2 of the CSDs that I created. I do have other CSDs. We have 2 of them here. Reaches 100%, closes below the 89%. That is a type 1 CSD, which meant in you to get some sort of discount. It consolidates for a while, which is just forming liquidity, because that's what this is. This is the liquidity layer. This is the layers where highs and lows and liquidity should form, which just is another way of saying accumulation, which is exactly what the rebalance layers does. And with enough study, you will see that the rebalance layers and the liquidity layers are just mirrors of each other. So that is a different topic that I will love to go into my private Discord and mentorship. If you're joined, you can go ahead and ask me all the questions you want to join there. So here, we're expecting something to happen. And here we have day 14, which is the CE between 11 and 17. And what does day 14 do? See discount. It's super close to the 50%, but the following day, here sees discount. Here we're starting again to accumulate. A low forms on day 17, which is another day of the hint, creates the swing, and now we are back in a buy program. And I hope you guys can see how Goldbach time, Goldbach monthly partitions can help you frame different moves in just this 1 month. Here we had the type 2 for a buy program, and here we had the type 1 for a sell program back into Clearview. And now we're back into a buy program that is neutral because we've reached the range high. So now, as Hoppy Locka would say, it's range decision time. We are either going to come back to form another low and discount or accumulate in the specific area, which is what it should do at a liquidity layer, or we're going to blow past this, take these highs that were engineered and the June high, close above this to then seek a new high. And before they even form a new all-time high, I'm calling it right now that there's going to be a high formed in this rebalance zone, and there's going to be a high formed above here, which is the range high of this next 2187 zone, because that's where they should form. So when people say, "How can you call the lower high?" Yes, you can literally call the lower high, and you don't need anything else besides Goldbach trifecta levels, and we'll combine just a little bit of Goldbach time. It doesn't have to be that complicated. Every month is the same: 1, 3, 7, 11, 14, 17. Every month, do that specific thing. Look for clues. Ask questions in the comments. If you want me to do more videos specifically about Goldbach monthly partition, I might do it. If you want a detailed analysis on how I use Goldbach partition along with my trifecta model, go ahead again, click the link below to join Trifecta HQ. As always, good luck and good trading. And before I let you.
Hello everyone, hope you're all doing well. Welcome back to another lecture. It's been a while, but I want to get on here and talk about something interesting, something that I think a lot of you could get something out of and understand the way I look at specifically the opening range. I want to talk and showcase a little bit about how I utilize time-based swings based on fallback time, as well as using the 930 opening range to actually define where I project my range to be. And what I mean by this is that I believe in the fact that the market will define its own range. You do not have to use any fixed price levels or anything like that. Instead, price will show you where it's going to reference. Now, how do we confirm these references? Well, that's where time comes in. And when you understand how to combine these two, combining both the time-based swings for your highs and lows, as well as the actual projected range using the 50%, etc., then you're going to have a very deep understanding of how the market actually moves. The market was coded in a way of including predetermined randomness, but none of it is actually random. That's the important thing. In fact, price is actually doing the exact same thing every single day, and it's just repeating. And what I mean by that is that your opening range, as well as your expansions and retracements, they will vary. It's also why you're going to get different time-based swings. It's not always going to be the same, but the numbers are always going to be the same. Now, to start off with, we're going to touch a little bit on the time aspect. Initially, I had a video on this, go back time producing it, but with respect to the initial author, I decided to take it down. However, now recently he has been uploading some videos to YouTube, putting it out there to the public. So I figured I might as well talk about my interpretation a little bit and basically why these numbers are important to me. Put it very simply, as you can see below here, we do have the table. Now this table basically contains the different algos. Credits to AJ for translating copy placas, rollback levels into the time axis. He was the one that I was talking about. He's been posting it on YouTube about this, so check it out his content if you want as well. Now, to put it simply, an algo either moves forwards or backwards, and it's important to understand that we're always looking to reference the next number based on our reference point. So if we have a 53 for the tangent down lower, we know that 53 is in our algo 2. It's not an algo 1. So that makes it simple. We know that the next likely number that we're going to look for is 11 or 14. So knowing that we have a 53 high right here, basically what this allows you to do, keep in mind, we're only looking at the minute factor of the time axis here. We're not adding or subtracting anything. Just keep it simple. The fact that we have a 53 high, we know that we have to wait, because unless we get a new high or a new swing that formed at a different time, we know that this expansion is going to keep going. And it's going to keep going until we reach 11, 14 on the time axis. And so what happens when 11 hits or 14 hits? How do we know that it's going to reverse? And this is where you can implement what I mentioned, which was the opening range. Now, what I mean by opening range, what I like to do, if you put on RTH just for simplicity's sake, this is only going to show you the regular trading hours and the New York session, basically. So no London, no Asia, no nothing. This is just to make it very clear, because this is where the market opened. For example, today, so let's see. The opening range is essentially from where a low is put in and a high, right? And so usually you'll have to wait around 30 minutes. So between 9:30 and 10, you can have basically a set model that tells you, I'm not going to look for any trades until after 10. The reason being is that you're letting price, actually inside of this window, you're letting price define a low to a high. And what do you do with this information? Well, it's simple. The most important levels, in my opinion, it's just going to be 0, 0.5, and 1. So let's say that we want to measure out our opening range. What we're then going to do is mark out from the low to the high a simple fib like this with 0, 1, 0.5. So we have defined our opening range, as you can see here. This price clearly displays the way from this low up to this high, from the high pushed away. Now, this is where the interesting aspect comes in, because if we want to determine how far price should push beyond the opening range, what we can do is we can project the same levels that we have here. So inside of your fib, you're going to add minus 0.5, minus 2, 1.5, and 2, because then you are extending that opening range. So imagine it like this. You have your opening range here. You've essentially done the same, projecting it lower and higher. And what you'll find interesting is, for example, today, if we look at the reaction and where our 14 low point, you cannot make this up. From 53, finding the range, price pushed down lower to where? The very lower end of our extended opening range to the tip. At what time? From at 10:15, which keep in mind when we're measuring based on time, we're using our ±1 buffer. So this means that we can have a 1 minute buffer on each side. So 15 is still valid as a 14. And so the way you look at these levels is basically if price continues pushing lower here, we look for a potential reaction either from the low, because we're sweeping that initial low, could see some reaction around here, or we wait for the midpoint. If we displace through the midpoint, what do we expect to happen then? We expect continuation, right? Unless we reject it, we're expecting price to go even lower. You can see that's the case here as well. You can see price displays through here, did not even have the time to come up and touch it again. Then just continues, rejects at the lower end here at 10 a.m. But like I said, it's not the right time because 53 does not go to 0. That is why time is important when you're using this. So then price will continue pushing lower, displacing through the next midpoint as well. You see this lines up very nicely with our opening range gap, which is also why we like to pay attention to those. Then price finally pushes down, touches the lower end, continues up higher again. Now, how do you enter based off this? This is something I talk more about in my actual model. So the codex model that I have, which you can find in the description, where I teach actually how to enter based off this, the requirements that we need, things we need to see, etc. But to put it simply, and if we go back to ETH, we want to see this push happen lower true opens. And then you can have this measured move based on the opening range. That's why I like to use RTH sometimes to just look at where this opening range formed. And usually that happens between 9:30 till 10. That's why a 10 open low or open high is also important. So actually today, based off of this, what we saw this low was being put in, I started expanding away, and I got in on a long around here. Now, what was I targeting based off of this? See, I entered as we slightly spaced away, just right here. My target was going to be that at 9:30 low, we broke through. And see how I'm playing within the range. And it's not a fixed range in terms of price levels. It is, however, fixed to current price, which in my opinion is much more accurate. This price is showing you it's defining the current range. So you don't have to guess based on volatility what we're going to react from. This price is already showing you exactly what it is that we're reacting from. It makes it a lot simpler. You can see that here, this price kept pushing. I took a partial around this imbalance here, and then just went fully out once we got back into that opening range. Now, if you had more runners, you see you could have held for the midpoint of the actual opening range itself and see what price did around that. Back and forth, just consolidating once it was reached. Then once price breaks out, what's our next target going to be? It's likely going to want to reach for these highs. It's just a perfect example how we can use these open ranges. And you'll know I've talked about something similar to this previously when I mentioned the weekly projections, where you're projecting the levels for Monday. Because to me, Monday is sort of an opening range as well. So the same concept applies. That is why also a lot of the time for Monday, I don't need to reference a lot of higher time frame areas of interest because I'm letting Monday define the range. So my focus is going to be on the lower time frame, and then once Tuesday comes around, looking for that manipulation based on what Monday has already shown me. So the concept of an opening range can be applied to higher time frame in that way. And this is something that takes a little bit of practice. You're going to have to look at multiple examples, but understand that price will show you where it wants to go. And you will know that it's going to react from that area when it's reached at the right time. Now, like I said, publicly, I'm not going to go too in depth on the actual time aspect itself, but it's something that I covered extensively. Find the link for that in the description. Like I said, that is where I have my full model, which actually shows you how to enter based on this and also what these times actually mean. Because I know just looking at this price action, I can hover over a high like this and already tell you that this retracement is perfect. This would have been a perfect entry opportunity, target 50% of the opening range, simply just based off time. There is a reason why you need to have a framework for both time and price. However, I truly believe that time is what runs the market. Time will tell you the where, but we can specify that even more if we let price show us what range we are currently inside of. Combine that with your true opens and you have a very strong framework already. If you just understood the concept of what I've briefly talked about here, without going into detail on the time aspect, you will truly have a different understanding. And it's going to be the same. I'm just looking at price here. These retracements, it's all predetermined. And until price breaks out of this range, completes it, we can still reference this as our range. And then we just let time do the talking. We're not going to try and short when price is up here and wait for those levels to be reached at the right time. Now, the way you can view this is also we are below in a discount. We are above, we are in a premium. So ideally, you want to only buy below and sell above. If price has already moved into premium, you want to wait for price to get back into the range. Because once we break above, we're now inside of here. We know that the target is going to be the upper end. So this means that our retracement, this one, earned by time, is going to be valid. So hopefully that makes sense, and you now understand a little more about what I'm talking about, what I'm looking at. If you want access to any of these indicators, such as the ones that at the time or
Hello, everyone. Welcome to another video here on my YouTube series. So this is not going to be a Outlook video, but it's going to be a video that was been super requested since I've started making YouTube channels and posting more on Poppy's Discord and AJ's Discord and whatnot. So I'm going to show how I determine my higher time frame order objectively through the trifecta levels themselves. So first, I'm going to show you how I determine CSD on the higher time frame, and specifically what time frame I pay attention to. So first, I'm going to start off by saying, as I would hope everyone knows, this is a range high, and this is a range low, and this is the equilibrium of the range high to range low. Everything above the 50% is considered a premium, and everything below 50% is considered a discount. These two levels are where you want highs and lows, These two levels are where you want lows to form, and these two levels are where you want highs to form. This is a premium flow gate, hence it being above the 50%, and this is a discounted flow gate, as it's below the equilibrium. So now, how do I consider a CSD, and how do I determine what program the NASDAQ is currently in on each power of 3 time frame? That's essentially what I'm doing. I'm stacking all the PL3 time frames together. Specifically, the 2187, I'm paying attention to that on the daily and on the 3-day time frame, but more specifically on the daily. So now let's say price has left the flow gate. We start here, and it has now reached the range low. When do I determine that this range low will become support on price and that it should hold for a buy program to continue? So the moment price has reached the area, you want to be neutral. You want it to tell you whether it's going to continue into the next partition or it's going to go back into the range and seek some sort of premium, which would be the equilibrium or the premium flow gate, and then essentially the range high. So once price has reached specifically the range low, which is 0% of this entire range, it has to close above the 11%. And the moment it has a body closure above that, you expect this entire range now to hold price, even better, the last line of defense here, to then continue, form some sort of displacement through here, and then maybe offer an Einstein plate where it reaches a flow gate, comes back to GIP, which is a 17%, and then continues onward, right? So the moment we have a body or wick touch the 0%, go ahead and write that down. Okay, so there we have 0% to 11% at range low. And at range high, it's the exact same thing, but inverted. What's the inversion of 11% or 11 on the close back partitions? With 89. So the same thing at a range high. If price is coming into it, it has to reach the 0%. Once it reaches the 0%, neutral, this price cycle has completed. And you do the same thing. You wait until it closes below the 89%, come back to it, use this entire area as resistance on price to then continue lower. So that is what I consider a CSD. This is one of the CSDs I consider on the higher time frame. This is what I consider a type 1. Okay, and there you have it. That is what I consider a CSD from a range high to a range low. This is not my specific findings. This is straight from Papilaka's book. If you have the trifecta book, which I do hope you have, and I was going to show an example from the book, but I'm not sure how he would feel about me showing the actual book that he charges for. But on page 3 of 9 in that book, if you go on to read, he says, you want to monitor levels. This is a specific quote, by the way. You want to monitor levels 1189 and 397, as well as range extreme 0, 100, and the last line of defense 793. Those are the specific words in the book, right? And he has a specific visual example in the book. It's essentially this. Price comes to a range low, taps into the last line of defense, 0%, and then he says once it displaces above the 11 or 89, as an example, it was a bullish example. There's a displacement above here, but it's essentially just a body close above. But that strong body close above essentially will give you a displacement on most of the time, on some time frame. Right? Like let's say daily displacement, you can come down into a 243-minute time frame, and you'll see implicitly in that area that you can interrupt. So that is how I play it, right? Now, what happens when it doesn't reach the 0%, or if it overshoots it? In this example here, when it reaches 0, and if it overshoots the 0, right? If say it reaches the last line of defense, or it reaches the lower end, which is what he used to call the ERD in the first trifecta, not trifecta, but the first gold block book, I would still wait for a close back above here, because you could reach this range and then just come back to the 0 and continue lower, right? So you have to wait to see a clear displacement above the 11. And it's not a wick above the 11, it's a body close above the 11. Now I'm going to go over an example of what happens when we don't reach the 0%. Okay, so let's say price does the exact same thing. It's coming from any area, either high or low. And it comes here, but it fails to reach the 0. Let's say it reaches somewhere here, right? It fails to reach the 0 and beyond. Would I still consider the pullback conversion point, or the 1189 as a CSD? So that's when I would wait for a clear displacement above. The aggressive one would be the 17%, right? Come back and use the give to continue higher, but you're asking for a lower run doing that, right? The clear CSD for me would be closing above the 29. The moment we close above the 29 flow gate, that sweet spot, right? The sweet spot should hold price. If it has a body closure above the 29 flow gate, I would consider this a CSD, and now this range should hold. So now the moment we come here and come back, it needs to respect this gap and the last line of defense and the low that I was created. From here to then continue onto the premium. This would be what I consider a type 2. Doesn't reach range 0, or the 0 range, not range 0% of this range, but it still displaces clearly above the gap, doesn't reject the gap, clearly displaces above it and through it, and also the 29, and preferably above the 35. The moment we do that, it's even better in my opinion, but it can still come here, come down to the 17% to continue. And this essentially is a Einstein trade plan from the trifecta book that doesn't necessarily reach the range low. This is kind of a low probability one, I would say. The type 1 is the best. This is what I consider a type 2. But this is also another CSD. So now, same thing from the top, just to show you a visual representation. So this is the visual representation from the top. It's coming from underneath, reaches the range high, fails to reach the 0. We wait until it's aggressive would be through the 83. Conservative would be through the 71 on the high end of this. And if you also read the trifecta book, Hoppy says that the 17% and 83% are visual representations of CSDs, right? So when you get price, go through it, displace through it, you want to see that hold. If not, that can be your first sign that there is a CSD or market structure shift, however you want to call it, index. Let's go ahead and write that down. Okay, so these are the two types of CSDs that I would consider from a range high or a range low. When it comes to the inside of the range, I treat those slightly different, but just to keep this video simple, from the range high and range low, this is how I would use the CSD, right? And this is for any time frame and any power of 3 when you're looking at it. Now, there's specific time frames that I use for specific ranges, and that's also based on what Hoppy says in his book. Okay, so I'm going to give a crystal clear list here on what specific power of 3 time frames I'm monitoring for each specific time frame. This again comes straight from the book. So on the book, Hoppy says that the 6561 power of 3 range is to be viewed on the monthly, but that he likes to go down one time frame, or however you want to do it, one time frame rate contraction to view price, right? And he gives 2 examples of this in the book. And he specifically says first start out on the monthly view from the top-down analysis, right? And he uses the 6561 on the NQ there. But to get a closer look at it, he says that the daily is acceptable. That the weekly is acceptable on the monthly time frame, right? So let's go ahead and write that down. And then he goes on to say that 2187 can also be viewed on the weekly, but that again, going down to the daily is acceptable for the 2187. So he's essentially saying that you can go down one time frame based on what specific power 3 range you're paying attention to, and that these 2 time frames here are the lowest ones that you should be paying attention to for your long-term bias, right? All right, so that is very crystal clear there. On the 6561 power 3 time frame, you're going to be using monthly and weekly candles to determine your CSDs, preferably the weekly on the 6561, so you can get a closer or sooner, faster change in state of delivery, or however you want to call it. On the 2187, weekly and daily, preferably you want to be paying attention to the daily to confirm your CSDs on the higher time frame. So when these 2 time frames are aligned and power 3 are aligned, meaning that the 6561 is same by program and the 2187 are both same by program, right? That is when you can drop down into the smaller power 3 time frames and do the exact same thing I showed you here to determine your CSDs, right? And just to give you guys a list here on the next time frame I would use for intraday, it would be the 729 range. So here, for my intraday time frame, once these 2 things are saying the exact same thing, I can then drop down to the 729 range and wait for price to reach a range high or range low, just the way I showed you guys here, to determine the CSD. So in both of these are in a buy program. And the 729 is doing an example that I showed you where it's coming from a premium, from a premium array, or the discounted flow gate into the range low to form the CSD. And then once the CSD is in, it would have all 3 saying the same thing. After that, however you determine your entry model and what you use to enterprise is totally up to you, right? But this is a clear-cut way to determine what program each power 3 is in based on when it reaches a range high or range low. And it also tells you what trades would be more favorable for that specific day or week. So every program or every power 3 price cycle is saying that it's in a buy program, and you're consistently shorting the market and hitting break even or taking losses, this is going to help you with that. And I'm going to show one more example of a CSD, just a bonus one that is essentially the same thing, but from a equilibrium. And I'll show you an example of that on the charts as well after this, and after I show you the schematic. And just to be clear, yes, you are using the 81-minute time frame on the 729 to base your CSDs using the bodies of the candles. Okay, now so there's times for prices coming from a range high or range low. This example would be coming from range high, and price goes through the flow gate and then reaches the equilibrium, right? At this current moment, the moment that price closes below this flow gate here, the 71 flow gate here, which is the premium flow gate of this price cycle, the 77 becomes the invalidation, or the 71 becomes the invalidation for a sell program. Because from the range high, if you remember the CSD, let's go ahead and do that again. Say price is coming from here and it closes below this 89 range, comes back, and then continues into the equilibrium, which would be a Einstein pattern. Now, the moment we've reached this equilibrium, if we close back above this 71 range, even better, the 77, this now becomes a CSD, and we can now use this flow gate here and this line here to enter again. But the moment it closes above, you can just essentially enter from there and expect both of these ranges to hold. So they continue higher and continue higher until we reach the equilibrium. When it does that, that's a specific equilibrium to equilibrium model, right? And sometimes you'll wonder why it didn't specifically stop here, here, or at the flow gate here. And then once we reach the equilibrium or this anywhere inside of this rebalance zone, that'll start to reject, right? And there's one thing that I figured out when paying attention to these price cycles is that they can have a range shift on them. So in the older version of the Goldbach book, on the demystifying ICT one, he mentions how you can have a range shift on that. And what does that necessarily mean, right? And how can this be a CSD and essentially be the same thing as a type 1, right? When we go ahead and take our fib levels and we use this exact same points that we have here, right? All these levels here, we use them to plot a new Goldbach range, right? Through the equilibrium to equilibrium. So let's go ahead and do that so I can show you what I mean. So when I plot a new range here using the equilibriums as the 0 and 100%, we have a new range low here and a range high up here. So if I go ahead and remove the trifecta indicator, okay, so when we bring out our fib tool and we plot the same Goldbach ranges using the equilibriums as the 0 and 100%, you can see clearly now that a type 1 is essentially the same thing happening here, right? So this would be, once we close above there, that would be the CSD, right? And if you pay attention, the 11% is here, and then the next, this kind of flow gate would have been here. So this CSD, which I said it preferably above the 77, also aligns with another CSD to here, and a type 1 from the range low, right? So the moment we closed above the 89 or 11%, which would be from here on the lows, let me go ahead and remove the trifecta. So we remove the trifecta, this becomes our range low. These are the last line of difference lines there. You can ignore that, but the 11% and the 17%, right? That's an aggressive CSD from the type 1 range shift is what I would call this. Now, the safest bet would be to wait until we close above that flow gate that we were rejecting, right? Because once we close below it, that should hold price lower. But once you close above it, then this entry here, which aligns here with the 29% on this new range, right? Let's go ahead and put that trifecta back. At first, you expect this flow gate to reject it, and that's essentially what it's going to do, right? And the moment it closes through the 71%, right, you expect this area to hold. And then here, continue on, continue on. And then when it reaches that equilibrium, you know that it's completing a range high to range low with the range shift on. So now, when it's coming lower, if you have some sort of time alignment here or whatever it is that you want to enter off, and you're bullish on all the other time frames, right? Let's say 6561 is bullish, 2187 is bullish, 729 is also bullish. And on a lower time frame, you're seeing this specific happen. You expect the 50% to be treated as a discount, and that price was seeking some sort of discount before it can continue higher. So that is my extra golden nugget that I have in there. And this, again, is all from Hoppy Locke's book, and this is my interpretation of it. And this is only to determine the higher time frame buys. And I'm going to show you an example of this specific move here. Alrighty, so here we are on the weekly time frame on the 6561 power 3. Price had reached a range high and started to consolidate. This is where Hoppy says liquidity forms and price will engineer highs and lows, right? To then attack later. Price then closes bearish here, meaning that this whole range became the invalidation of a sell program. And then it continued lower until it reached exactly the 50%. Right? So if you're paying attention to that, that is the 50% of this range here. So let's go back. So now we can see that that is the 50% of the range, and it tapped it literally perfectly. 963.5. This low comes in at 961.5. 2 points below it, right? Now, if we go ahead and use the fib tool from here to the next range, when we go ahead and do that, you can see that this candle closes above the 89 and right at the flow gate, right? So you can start to already view that as a CSD or as an aggressive one. When you start going into the lower time frames, if the 2187 is also saying the same thing. Okay, so we saw on the gold back fib that this was already somewhat of a tight CSD, right? Or an aggressive one that you can use already based off of that. So then we go ahead and look at the next candle just to be more certain. So the next candle here closes clearly above this premium flow gate, right? Which should have held the price lower. So that is an obvious CSD, and this next week and the weeks after that are going to be bullish. And coincidentally, the news around the world became very, how do I say? The news around the world fit the current move, right? So that's another topic that we can go down another rabbit hole. But in hindsight, we can go ahead and see how this move played out. And if it is an equilibrium to equilibrium model that is still in play on the weekly time frame, this 50% is the target. That is also another little outlook. Closing above this range. Now this is the invalidation for this weekly power 3. So until we close above this flow gate, this is the invalidation of a 5 program on the weekly. And that is the example of the second version of what I consider a type 1 CSD with the range shift on. You have the regular one, which you can see here very clearly. That one, those tend to happen very often, right? The moment we closed here, you could have been something on the daily to help you see that. And it comes to there. All right, this is a CSD. And then look, it would have took, if you were holding this on a swing trade, it would have took you weeks. You would have grew gray hair before we actually reached the equilibrium. But yeah, hope you guys enjoyed the video. I hope that helps some people with, build some sort of.
And look, you can see it hasn't been really bleeding through in break-even rates. What would your response be?
I mean, I would leave it to others to do the relative attribution, but it's clearly a function of loose fiscal policy, loose monetary policy, price insensitive supply, both from corporates and from the government, and more price sensitive demand. I think the reason to hike rates is we still have a decent share of our economy that's rate sensitive. The housing market, you have wealth effects, you have big consumer durable items that are sensitive to rates, and you have wealth effects. So the Fed should control what it can. It can't change the fact that hyperscalers are issuing at record levels. It can't change the fact that there's no political appetite to reduce deficits. But what it can do is reduce demand and shore up inflation expectations.
If the Fed does not hike in September, are you more likely to buy overseas? Are you more likely to protest U.S. assets just by virtue of a lack of faith in a reaction function that is tied to the economy?
Well, I mean, I think markets are telling you what they will do if the Fed continues to sit on its hands. It's going to continue to sell the long end. It's going to continue to sell dollar. It's going to buy gold, buy digital assets, buy non-dollar currencies. That trend would continue. So I'm hoping that it drags them whole. We get more of a message that, look, we understand we're living in a world of connected, repeated, and compounding supply shocks that are net inflationary. We understand that policy right now is loose, so are financial conditions. And we don't think that bygones are bygones. We know we missed the target for 65 months, and that inches us closer to a psychological tipping point that's really costly to recover from. If Chair Warsh delivers that message, I think September, October, and December would be live. That would be a good thing because it would be on the path. We'd be on the path to reestablishing a nominal anchor for the world we live in.
That's the speech you want.
That's the speech I hope we receive.
What's the speech that we'll get?
Look, I have to say, I think Kevin Warsh is a highly credible Fed chair. He's his own man. He is not a sock puppet. And I think people are mistaken if they think he's going to deliver a better speech, especially because of what we just saw at Treasury. That's a mistake.
What would it mean for the front end doom loop if he does make that mistake?
If he does not deliver a hawkish message, well, then I think the long end loses its anchor. And so it's not a front end doom loop, it's a long end doom loop. Yes. And so you're going to see what we've experienced over the past month, some multiple of that type of pain in the long end. And so there's no way out of this other than to tighten monetary policy.
I don't want to start a fight with you and Robert Tip over a paycheck. But Robert is one of those individuals that talks about the return to normal.
Yes.
And the return to pre-GFC interest rates. Is that incompatible with the current debt dynamics of the United States?
Robert's a lover, not a fighter. I mean, look, we are.
But are you a fighter, not a lover?
Yes. I have said we're returning to what I call the old normal. Okay, so the great moderation was the geoeconomic anomaly. We're back to a world of fiscal dominance, economic warfare, energy insecurity, and a capex race to the commanding heights of cutting edge tech. All of those forces push up inflation, they push up nominal GDP growth, they push up yields. The difference is, and this is, I think Robert would acknowledge this, we have a debt stock at 100% of GDP. We have all-time highs in interest expense. It consumes 20% of our federal revenues. And we have a price-sensitive buyer base. So that means your room for policy error is really small. And I'm afraid we're committing some of those errors, with all due respect to Treasury.
Could speak to all that, Thank you. There'll be no fights in PGM. They're all kind guys. We know that, right?
Well,
right?
Yeah.
Yes. Right. You say yes.
Yes, they are all kind.
It's not going to throw hands, is he? Come on.
Hold on a second. Just because they're kind doesn't mean that there are some very serious, rigorous discussions about what we do with the deficit, which is clearly on everybody's
mind. We don't have those serious, rigorous discussions right now because the fundamentals right now all equal. They all equal a higher clearing price to get treasuries away, high clearing yield. And the Treasury is going to do everything they can to fund down. Question is whether the Fed steps out or steps in and comes along for the ride.
And whether that will help or hurt, given how sides potentially come in.
Thank you, Tilly. Thank you, sir. Up next on the program, Jeff Jacobson of 22V Research warning that high yields could begin weighing on housing stocks.
Good profit.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Week on Wall Street made for stories of capitalism, business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Trading day is about to start.
You're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
Could have been the other way. Obviously, this stuff is risk weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
Green revolutions and what?
I'm Guy Johns.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Free trading day.
Oh yeah, unbelievable.
Equities pulling back here, a few miles away from the opening bound. We're down a few tenths of 1%. No drama just yet, but down 0.2 on the S&P, down by 0.3 on the Nasdaq. Plenty of drama at the long end of the yield curve. Check it out this morning. Since 10 to 30s, yields this morning at the long end of the curve actually rising by 3 to 4 basis points. Now, I wonder if this is where some of the pain is coming from the equity market. Now, I don't want to make too much of a 0.2%. So the S&P 500, but I'll make some of this. I'll make something of this. 4 basis points on 10s, up by close to 4 on 30s. That's the one today. This move from the Treasury yesterday doesn't hold, and you start to see yields creep back towards 530 again. We may have a bigger problem than what we've had before.
It's a credibility problem with what the Treasury Secretary can do, but not to mention what the Fed's response might be. Starts to raise questions about why there is panic, given where yields are, given that so many different people were saying before, it's only because the economy is going so well that yields are higher. Why then is it turning into something more like a crisis?
Yeah, this 30-year yield, if it keeps grinding higher, it's not going to be a happy birthday to the Treasury Secretary tomorrow when it comes to this, because no one really thinks that they did this to have more liquidity. This feels like an intervention to try to bring yields down, and it feels like a Band-Aid.
The moving crude one, we're higher by more than 3% this morning, approaching 89 on WTI. Brent crude this morning at 94 and up by close to 3%.
Not good. And honestly, Peter Cheer talked about the fact that we are 40-year low of our SPR. Potentially there's damage that's being done. At these levels, the United States can't go out and buy and fill up.
The president is talking about more economic pain to the Iranians. Well, that's going to mean having to go after the Chinese. Does anyone actually see that happening before Xi Jinping comes in a midterm election?
You've got higher crude prices and a weaker US dollar in the last 24 months. If you're at the Federal Reserve, I think a basic question, and we'll speak to Mary Daly of San Francisco in 60 minutes. Are we seeing an unwarranted easing of financial conditions, of yields, weaker dollar, that would cause them to look at this and say, this is something we need to respond to? I don't think we are just yet, but you start to wonder if that's the direction of travel. That's the conversation they're having already. Are we sufficiently restrictive? And if you start to see yields low at the long end because the Treasury's stacked again and a weaker dollar, see if any of this holds, that's something they have to confront.
Yeah, where is this in your dashboard of economic data if you're increasingly data dependent, especially between now and September?
Mary Daly, 60 minutes away as we count you down to the cash open a few hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. It was a rare sales miss for Target and shares for Walmart, and shares are really paying for it, down 6.3% after U.S. comparable sales grew at the slowest pace in more than 6 years and below even the lowest targets on Wall Street. And there are some signs the consumer is pulling back. Shoppers made about the same number of trips, but they spent less each time. Lower pharmacy prices were also part of the problem for this company. Walmart, however, did raise its full-year outlook, suggesting it may see some of this weakness as manageable. Meanwhile, we're seeing Alibaba shares also falling down just under 3.7% after its results showed profits plunging more than 75%. The big drag is the spending it's doing on AI, while a broader slowdown in the Chinese consumer is hurting its e-commerce business. The earnings call is underway right now, so no doubt they will be asked how much more spending they are planning. And we are seeing a rally in crypto-linked stocks like Coinbase and Strategy, and there are a few reasons behind this move. That drop in treasury yields helped Bitcoin as investors move into riskier assets. We had the president meeting with crypto executives yesterday at the White House, urging Congress to pass the Clarity Act to have a risk-on move in crypto. John.
All right, thank you. More from Yahara in the next hour. On our radar this morning, a tentative trade deal is emerging between the US and Canada. Sources telling us here at Bloomberg the agreement would lower tariffs on some Canadian steel and aluminum exports to 25%, while cutting duties on auto exports to 15%. Elsewhere, while extending gains as the US ramps up pressure on Iran, the president announcing, quote, economic warfare and isolation on a unprecedented scale, warning any country that helps Tehran will face tremendous economic consequences. Finally, the Treasury Secretary, Scott Bessent, increasing purchases of longer-dated US debt. Strategists at JP Morgan warning the move could signal a lack of credibility, calling it, quote, highly unusual. Citi saying the efforts will cause short-term dollar weakness.
Pretty much universally, people are seeing this dollar weakness as persisting. I want to lean into that JP Morgan note for a minute. They talk about the potential perceived lack of credibility should this persist.
This from Jay Barry.
From Jay Barry, saying absent real fiscal consolidations, that would be where the lack of credibility would come from. In other words, you can't fix a fundamental problem with a tactic, and that is the ultimate question that market participants have. At what point do you have to address the underlying problem, or can we just inflate our way out of this?
Good luck addressing budget concerns. We have a massive military budget. 60% is basically stuff no one can really start, slicing and dicing away in Congress. It's Social Security, it's Medicare. And then on top of that, we're paying some $3 billion a day just on net interest payments. And no one is doing anything about wanting to bring this down. And yesterday was a huge milestone, 40 trillion.
I'm right there with you. The supply demand backdrop is getting harder, not easier. Dilly put it really well. I believe Steve Clinton was with us about 10 minutes ago. He said, increasingly we have a price insensitive supplier from not just the Treasury, because they have to issue for those issues, but also from big tech, and increasingly a price sensitive demand backdrop. It's not a great mix right now, is it? It really isn't.
So Barclays put out a note earlier last week that I thought was really important, where they said official demand for treasuries coming from governments, both domestic as well as international, only accounts now for about 50% of overall buyers, down from 73% a decade ago. The rest are price sensitive buyers. In other words, the number of people who are saying, show me what you got in terms of yield is increasing and are the price setter when it comes to these treasury options.
Otherwise, of course, paying the price for some of this for rising borrowing costs, a 5-month rise in yields pushing mortgage rates to their highest levels in about a year. Jeff Jacobson of 22V Research warning the move could start to impact investors as well, writing, we are possibly coming to a tipping point in the areas that are traditionally tied to rates and likely to put pressure on the housing stocks. Jeff joins us now for more. Jeff, welcome to the program, sir. Can we just start with the housing sector? How much stress is there out there in this economy, in the housing sector?
Well, we're starting to see signs of stress. Whether you're looking at the collapse in lumber prices over the last month, a lot of the public home builders have been saying, that they've been have to increase their incentives to get buyers to the table. We know that there's, clearly affordability issues, and rates being where they are just not helping the situation. And to your point earlier, if this intervention, if you will, in terms of what the Fed is trying to do, if it fails and rates move higher, we know what's going to happen in terms of the sentiment in terms of the rate sensitive home builders.
We haven't really seen higher yields affect overall equities so far. I mean, it has been sort of tempering some of the more economically sensitive areas, but otherwise you've seen a rally despite the sell-off in long-term rates. At what point does that start to materially shift in a broad-based way?
Well, that's my concern. I mean, the market overall has done a phenomenal job pretty much ignoring the move higher in yields. Home builders, yes, they've absolutely underperformed, which makes sense. But on an absolute basis, they haven't done that poorly. My concern is if we do start to see weakness in the overall market, I would think it would be certainly led by the rate sensitive sectors, assuming that it's yield that's the main concern of the market. And that was my main point of the note.
Why do you think housing has held in so well, given the fact that we've seen sales numbers decline significantly, affordability has dropped off the cliff, and prices haven't declined enough to make it truly competitive versus renting in many different municipalities?
I think they held up well. First of all, we've had periods of rotation in the market. So as money has come out of, say the tech or AI trade, it's worked its way into the more cyclical parts of the market, like home builders. That's certainly given it a bit. I think in general too, the home builders, which are obviously more sensitive to new home construction, had actually benefited because there's a lack of sellers, because people didn't want to sell their houses and move from a 3% mortgage to say a 7% mortgage. That may have dropped up or down. You basically you're possibly at a point where you've just run out of home buyers in terms of affordability, and that would also be a concern for the new construction home builders that they're leveraging.
Jeff, are you expecting any policy when it comes to housing out of Washington? I mean, there was a lot of mulling around Washington, and the president was going to declare a housing emergency at the State of the Union in January. It still hasn't happened.
Yeah, I mean, that's been talked about for a while. We haven't really seen anything yet. And again, I just don't know at this point how much they can do, again, with home affordability where it is, and certainly where yields where they are. I'm not sure, what they can do to really boost the market at this point.
When it comes to where mortgage rates are right now, are you getting a sense from this administration, given what we saw from the Treasury Secretary yesterday, that is one of their concerns to try to bring down mortgage rates, even though it might not even help?
I mean, I think that they're concerned about bringing rates down, unilaterally. Again, I just don't know how much it's going to help and at what costs. I'm not sure at this point a slight move lower in yields on the long end in terms of mortgage rates is going to do enough, again, against the backdrop of, affordability being at some of the worst levels we've seen. And I'm just not sure, a small move lower in yields at this point is going to be enough to boost demand at this point, affordability.
Jeff's got to say thank you, Jeff Jacobson, then 22V Research. Jeff's not alone. Ultimately, you need to see rates back to 5, and at the moment, the mortgage rates were closer to 7. Either you're going to see that, or you're going to see a correction in price. But no one wants to vote for a correction in house prices, though, right? No one wants to vote for that. No one wants to vote for a tighter deficit either.
Especially if they own housing, which is a large part of older Americans who tend to vote more aggressively and have more purse power when it comes to donations. Look, I'm a homeowner. You hate to see prices go down significantly, but there has to be some sort of right sizing for there to be some sort of clearing levels. We saw sales levels
last week fall off a cliff, and this is just a continuation of a trend.
You feel better if you sit on it with 3% mortgage, right?
It makes,
softens the blow.
it softens the blow of the deficit and everything else until the economy around you collapses.
No, but you know, it makes you feel good. So
It's a massive splash.
it's a huge flag.
It's massive. Yeah,
It's literally like saying you've got a Lamborghini on the drive.
yeah,
Like
it's
3% more.
it's literally my only flex because I didn't buy in the depths of the pandemic. There was nothing else that I've succeeded in, so my one flex is a 3% mortgage. Hallelujah.
Congratulations.
Thank you. I've been basking in it for the past
This is how you're running for 20
10 years.
But my one success,
And I can
Well,
come with me. And I can give, I can,
remortgage at the
and
right
I,
time.
and I can bring one to you.
More than that's what for grandma.
Yeah,
Diet for it.
thanks. I appreciate it. Protect the bears.
There we go. Let's give an update on stories elsewhere this morning. We get Bloomberg Brief. Bonnie Quinn has more. Hey, Bonnie.
Thanks, John. U.S. is reportedly conducting an operation to transport oil through the Strait of Hormuz. Axios is reporting that U.S. officials are saying they're using a southern route along the Oman coast. Ship tracking data shows 3 China-linked supertankers U-turned in the strait, though, in the past 2 days. North Korea denies any direct communication between Kim Jong-un and President Donald Trump. The denial comes as Trump says he expects to meet with him this year. A statement from Kim's partner says while relations between the leaders remain excellent, hostile U.S. policies toward the north haven't changed. Data center is quickly becoming a midterm election issue. President Donald Trump praising the AI build-out, but saying the industry needs an energy down.
The jobs are enormous and the money paid, the taxes paid are just enormous. And if you don't take it, you're going to be left behind. Maybe you can use a little public relations help. But if I were a governor, man, I would want that in my community.
President Trump going on to share he will be meeting top AI voices next week. And that is the Bloomberg Brief. John.
Don't just say it's in Mar-a-Lago. That was next.
He's asking for it. I highly doubt it.
I doubt it too.
I highly doubt it.
By there, one of them by the golf course. Don't see that happening.
No red or blue state right now. The direction of travel is. They're hearing what people have to say and voters have to say, and they don't want data centers.
It's probably easier to say those things when you're not running.
Yeah.
Right. Anyone who's running right now is saying something very different about data centers.
So Josh Shapiro's running. He was talking about that. Just put a limit in the guardrail. Yeah, guardrails around it. Don't leave us anyway. Which, what's your data center? My data center. The midterms in 2028. Just wait for my Jacksonville speech.
Inquiring minds want to know. I look forward to that speech. Up next on the program, taming long-term rates.
At this point, I'm like, go ahead, just hike and move on with it. In the absence of clarity of what the Fed will do with inflation, the inflation data makes it look like the Fed doesn't need to hike.
Up next, Canadian Growth, Health BNP Paribas.
Well, mentor Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it. Wow. Everyone has a dream. And a lot of dreams are, my dream is to play football, play professional football, and you get the dream come true, but it is going to end. And the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Not, you don't start in the third floor or the lobby. You actually have to start in the basement.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Medika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today. Investors, top executives, global innovators, join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with Haslinda Amin, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Down 0.25% on the S&P 500. This session low is down 0.4 on the Nasdaq. This is worth watching. The long end of the yield curve right now. Yields creeping higher again. Going into that decision, that announcement from the Treasury, yields were around 526-ish, going into 830 yesterday. We're only 3 basis points away right now, Bravo. Higher on the session by 4.
Yeah, people questioning how much firepower the Treasury really has to do something in order to buy back enough of longer-term debt in order to reduce the supply side problems. Can you just defer it all to the front end? How much are they actually going to do? We don't get a sense of what the action will be on September 9th. We have a lot of AI issuance until then, and frankly, we've got a lot of questions around the Fed policy coming out of Jackson.
The effects of the intervention in Japan weren't durable and weren't sustained. There'll be a question mark about whether this will be in the Treasury market. Under surveillance this morning, taming long-term rates.
At this point, I'm like, go ahead, just hike and move on with it. In the absence of clarity of what the Fed will do with inflation, you get a rally in twos and think, okay, maybe we're not going to get a hike next month. But the long end comes up because of concerns about that. The inflation data makes it look like the Fed doesn't need to hike.
So here's the latest this morning. The rebound in long-dated treasuries running out of steam as the Treasury doubled its debt buyback in a bid to rein in long-term borrowing costs from multi-year highs. Ganeet Dhingra of BNP Paribas writing, the July FOMC has left 30-year bond yields especially vulnerable, where either they keep rising as Fed credibility remains in question, or the market needs to price 3 to 4 hikes before yields could stabilize. Ganeet joins us now for more. Ganeet, good morning. I give you a shout out often because I go back to a note I put out a couple of months ago on the 30-year saying that 5% was not a ceiling. There's something here had changed. Can we start there? What's changed about the backdrop for long-dated rates?
Yeah, look, I think the fundamental picture is very, very different from what it was last year. I think the issue with Fed credibility is really top of mind right now. You mentioned it at the beginning of the program. The issue is if you have this problem with credibility, now the market finds itself in a situation where it's darned if they hike, darned if they don't, right? If they do, maintain their silence, don't offer any new information, the market continues to push the credibility theme. And that's why in the last, 2-3 weeks, we've had this K-shaped bond market, right? 2-year yields are down, 30-year yields are up. That K-shaped bond market is very rare. It's a sign of faltering credibility. So if they don't say something to fix that, let's say at Jackson Hole, that K-shaped bond market continues, long end yields are higher. Alternatively, to regain the trust, they will have to do more than what they were promising before July. The 2 hikes may not cut it now, maybe 3, maybe 4. That'd be a good start.
What's the scenario that you'd bet on right now?
Yeah, so our scenario, as you know, the BNP call is we start with hikes in December, 3 back-to-back hikes, December, Jan, March. Can the hike start in September? Given the economic data we have, I think they can. I think it's not a foregone conclusion that September is not going to happen.
The pushback is that ultimately yields are not rising in response to higher inflation expectations. This isn't coming as a result of an economy going gangbusters or